Are you ready to take control of your financial future? Today, we're diving into the 8 crucial investing rules you need to know to achieve success. Let's get started. Investing is key to building wealth and securing your financial future. It helps you grow your money faster than saving alone, benefiting from economic and business growth. Following proven investing rules is essential for making smart decisions and maximizing returns. These rules help you avoid common mistakes and stay on track, regardless of market conditions. In this video, we'll share 8 crucial investing rules with actionable tips you can implement right away. Let's dive in and start building a stronger financial foundation. In this channel, we empower you to achieve financial freedom and build a millionaire mindset. Subscribe to our channel for more on financial freedom. Remember, financial freedom is not just a dream, it's a choice. Let's make it happen. Rule 1, start early. One of the most important rules of investing is to start as early as possible. The reason is simple: compound interest. Compound interest means you earn interest not only on your initial investment, but also on the interest that accumulates over time. It's like a snowball effect, where your money grows faster and faster the longer it's invested. Starting early gives you more time to benefit from this compounding effect. Even small amounts can grow significantly over time. For example, investing $100 a month at age 25 can grow much larger than starting the same investment at age 35, thanks to the extra years of compound growth. The long-term benefits of starting early are clear. You'll have more financial security, more opportunities to achieve your goals, and less stress about your financial future. So the sooner you start investing, the better. Rule 2, diversify your portfolio. Diversification means spreading your investments across different asset classes to reduce risk. Instead of putting all your money into one type of investment, you spread it across stocks, bonds, real estate, and other assets. This way, if one investment performs poorly, the others can help balance it out. The importance of diversification lies in its ability to protect your investments from market volatility. By having a mix of assets, you're not relying on the success of a single investment. For example, if the stock market drops, your bonds or real estate investments might still perform well, helping to cushion the blow. A well-diversified portfolio might include a combination of large cap and small cap stocks, domestic and international investments, bonds, real estate, and perhaps even commodities like gold. This variety helps ensure that your overall portfolio remains stable and grows steadily over time. Rule 3, understand risk and return. Understanding the relationship between risk and return is crucial for successful investing. Generally, the higher the potential return of an investment, the higher the risk. It's important to find a balance that suits your financial goals and risk tolerance. Different types of risks can affect your investments. Market risk is the possibility of losing money due to changes in the overall market. Credit risk involves the chance that a bond issuer might default on payments. Interest rate risk affects the value of bonds when interest rates change. Balancing risk and return involves assessing how much risk you're willing to take to achieve your financial goals. For example, younger investors might take on more risk for potentially higher returns, while those nearing retirement might prefer safer investments to preserve their capital. By understanding and balancing risk and return, you can create an investment strategy that aligns with your financial objectives and helps you navigate market fluctuations more confidently. Rule 4, stay informed and educated. Continuous learning is crucial for successful investing. The financial world is always changing, and staying informed helps you make better decisions. Knowledge empowers you to understand market trends, evaluate investment opportunities, and avoid potential pitfalls. There are many resources to help you stay updated. Books by renowned investors, financial blogs, and online courses can provide valuable insights. Subscribing to financial news sources and joining investment communities can also keep you informed about the latest developments. With a solid understanding of investing, you can make more informed choices, identify opportunities, and manage risks effectively. Education is a powerful tool that can significantly improve your investment decisions and outcomes. Rule 5, keep emotions in check. Emotions can have a big impact on your investment decisions. Fear and greed often lead to poor choices, such as panic selling during market downturns or chasing after high-risk investments. Managing your emotions is essential for maintaining a disciplined approach to investing. Having a clear investment plan helps you stay focused on your long-term goals, even when the market is volatile. Avoid making impulsive decisions based on short-term market movements. Sticking to your plan and keeping your emotions in check can prevent costly mistakes and keep your investments on track. A disciplined approach ensures that you make rational decisions based on your strategy, not your emotions. Rule 6. Set clear financial goals. Setting clear financial goals is a cornerstone of successful investing. Goals that are specific, measurable, achievable, relevant, and time-bound, smart, provide direction and motivation. Examples of financial goals include saving for retirement, buying a house, or funding an education. Each goal will have different time horizons and risk tolerance, which will guide your investment strategy. Clear goals help you determine how much you need to invest and what types of investments are suitable. They also help you stay focused and disciplined, making it easier to track your progress and adjust your strategy as needed. By setting and pursuing clear financial goals, you can create a roadmap to achieve your financial dreams. Rule 7. Review and rebalance regularly. Regularly reviewing and rebalancing your portfolio is essential for maintaining your investment strategy. Rebalancing means adjusting your portfolio to maintain your desired asset allocation. This is important because over time, some investments will grow faster than others, causing your portfolio to drift from its original allocation. You should review your investments at least once a year. During this review, check whether your asset allocation aligns with your financial goals and risk tolerance. If not, you may need to rebalance by buying or selling assets to restore the desired allocation. Rebalancing keeps your portfolio aligned with your goals and helps manage risk. It ensures you're not overly exposed to any single asset class, maintaining a balanced and diversified portfolio that supports your long-term objectives. Rule 8. Avoid high fees and expenses. High fees and expenses can significantly impact your investment returns. Even seemingly small fees can add up over time, eating into your profits and slowing your progress towards your financial goals. To identify and minimize fees, look for low-cost investment options such as index funds or ETFs, which often have lower expense ratios compared to actively managed funds. Be aware of management fees, transaction costs, and other charges that can add up. Choosing low-cost investment options helps maximize your returns by keeping more of your money working for you. By minimizing fees, you can achieve better overall performance and reach your financial goals more efficiently. Applying these rules can set you on a successful investing journey. Remember, investing is a long-term commitment, and following these principles can help you build a secure financial future. If you found this video helpful, subscribe for more investing tips and financial advice. Thanks for watching and happy investing.